Every empire believes its gold will last forever. Every emperor, every king, every president looks at their treasury and sees permanence. But history has a different story to tell. And right now, that story is screaming at us through a signal so clear, so undeniable, that ignoring it would be financial suicide. Gold just shattered through $4,000 per ounce for the first time in human history. Not a small milestone, not a temporary spike. This is the monetary equivalent of a fire alarm going off in a building filled with sleeping people. And if you understand what this signal has meant throughout history, you'll realize we're not just watching numbers on a screen. We're watching the early stages of a collapse that has destroyed every great power before us. The pattern is always the same. An empire grows powerful, builds massive armies, conquers territories, and promises its people prosperity forever. The gold flows in. The currency looks strong, and everyone believes the good times will never end. Then something shifts. The costs mount. The wars drag on. The debts pile up. And slowly, quietly, the empire begins feeding on itself. The gold signal starts flashing, and those who recognize it early become the survivors of what comes next. Here's what makes this moment different from every other financial crisis you've lived through. This isn't about one country or one currency. This is about the entire global monetary system showing the same warning signs that preceded the fall of Rome, the collapse of Spain's empire, and the hyperinflation that destroyed Weimar Germany. The gold signal doesn't lie. It never has. And right now, it's telling us that 2026 could be the year everything changes. Let me show you exactly how this signal has played out across history, why it's flashing brighter than ever before, and what you need to do to position yourself on the right side of what's coming. The Roman Empire thought it had solved the problem of money forever. For centuries, their silver denarius was the most trusted currency on earth. Roman soldiers carried it into battle. Merchants across 3 continents accepted it without question. Families saved it for generations. The denarius wasn't just money. It was confidence in metal form. But running an empire costs money, massive amounts of money. Legions had to be paid. Roads and aqueducts had to be built. Barbarian tribes had to be fought on multiple fronts. And by the 2nd century after Christ, the math wasn't adding up. Tax revenues couldn't cover military expenses. So, the emperors discovered the same trick that every failing government discovers. They could create more money by making each coin worth less. Under Augustus, the denarius was 95% pure silver. By the time of Caracalla, it had dropped to 50%. By Gallienus, less than 5% silver remained. A coin that once contained real value had become a bronze disc with a silver coating. The people could see it, they could feel it, and they stopped trusting it. Inflation exploded across the empire. A measure of wheat that once cost a single denarius suddenly required dozens. Soldiers demanded higher wages. Merchants refused to base coins. Local economies collapsed into barter systems because the currency was worthless. The more confidence eroded, the more coins the emperors minted, hoping volume could replace value. It was a death spiral that lasted 50 years and left the Western Roman Empire too weak to survive. But here's the crucial detail most people miss. While Rome was debasing its silver, gold held its purchasing power. Those who recognized the warning signs early, who converted their savings from silver to gold, preserved their wealth while everyone else watched theirs evaporate. The gold signal was flashing. Most Romans ignored it. The few who didn't became the survivors. Fast forward to 16th century Spain. The Spanish Empire controlled more gold and silver than any kingdom in history. Treasure ships from Mexico and Peru brought endless streams of bullion across the Atlantic. Spain should have become the richest, most powerful nation on earth forever. Instead, it collapsed under the weight of its own treasure. The problem wasn't the gold itself. The problem was what Spain did with it. Instead of investing in productive industries, they spent it on wars, luxuries, and imports. Instead of building a sustainable economy, they became addicted to the treasure fleets. And when those fleets started getting captured by pirates or lost in storms, Spain couldn't pay its debts. The empire that owned half the world's gold declared bankruptcy 4 times in 50 years. But again, the gold signal was there for those who knew how to read it. Spanish gold was flowing out of the country as fast as it arrived. Prices were inflating rapidly. The currency was becoming unstable. Those who held real gold stored outside the Spanish financial system preserved their wealth while the empire crumbled around them. The pattern repeated in Weimar Germany. After World War I, the government started printing marks to pay war reparations. At first, it seemed manageable. Then it accelerated. By 1923, hyperinflation was raging. A loaf of bread that cost 1 mark before the war cost 200 billion marks by the end. People carried wheelbarrows full of cash to buy groceries. But gold told a different story. As the mark collapsed, gold's price in marks soared into the trillions. Those who had converted their savings to gold before the hyperinflation began survived financially. Those who trusted the government's paper currency lost everything. The gold signal had been flashing for years before the final collapse. Most Germans ignored it. The few who didn't preserve generational wealth. Now look at today. Central banks around the world have been accumulating gold at unprecedented rates, over 1,000 tons per year for the last 3 years. That's more than double the historical average. China alone has been buying gold aggressively while quietly reducing its holdings of US dollars. Russia has been doing the same. Even traditional Western allies are diversifying away from dollar reserves into gold. This isn't random. This is the same behavior pattern that appears before every major monetary system collapse. Central banks are the ultimate insiders. They have access to information you and I will never see. And when they start hoarding gold, while their public statements insist everything is fine, you need to pay attention. The numbers tell the story. Global debt has exploded to levels never seen in human history. The United States alone carries $36 trillion in debt, growing at 9% per year. At that rate, the debt doubles every 8 years. The mathematics are simple and brutal. This cannot continue indefinitely. Something has to give. Meanwhile, the response to every crisis has been the same. Print more money, lower interest rates, flood the system with liquidity. The Federal Reserve has expanded the money supply by trillions of dollars since 2008. The European Central Bank has done the same. Every major central bank has followed the same playbook. Create money out of nothing to solve problems created by creating money out of nothing. This is exactly what Rome did with the denarius, exactly what Spain did with American silver, exactly what Germany did with the mark. The technology has changed, but the fundamental mistake remains identical. Governments always believe they can create wealth by creating money. History proves they're always wrong. Gold is responding exactly as it has throughout every previous collapse. The price surge isn't speculation. It's not manipulation. It's not a bubble. It's the market's way of saying that confidence in the current monetary system is breaking down. When gold hits $4,000 per ounce, it's not celebrating its own success. It's mourning the failure of everything else. The forecasts for 2026 are staggering. Multiple analysts project gold could reach $5,000 to $6,000 per ounce within the next 18 months. Some models suggest even higher levels, but these aren't wild predictions. They're mathematical extrapolations based on current trends in money printing, debt accumulation, and central bank behavior. Here's the most important number. Only half of 1% of global financial assets are currently invested in gold. In 1980, that figure was 2.7%. If gold investments returned to 1980 levels, it would require 230,000 tons of gold. That's roughly equal to all the gold ever mined in human history. The supply simply doesn't exist. The only way to balance that equation is through dramatically higher prices. The gold signal isn't just flashing. It's blazing like a beacon in the darkness, warning us that the monetary system we've lived with our entire lives is approaching its expiration date. Every empire in history has faced this moment, and every empire that ignored the warning paid the ultimate price. The question isn't whether this collapse will happen. The question is whether you'll be prepared when it does. Because while empires crumble, individuals can survive and even thrive if they understand what's coming and position themselves accordingly. Look at what happened in Lebanon between 2019 and 2021. Lebanese banks simply locked their doors. Citizens who had trusted the system for decades suddenly found their life savings frozen. The Lebanese pound lost 90% of its value in less than 2 years. Families who had worked their entire lives to build wealth watched it disappear overnight. But here's what most people don't know. Those who had moved money out of the banking system, those who held gold or foreign assets, those who saw the warning signs early, they survived. The Lebanese collapse wasn't unique. It was just the latest example of a pattern that repeats throughout history. When monetary systems fail, they don't fail gradually. They fail suddenly. One day the banks are open, the next day they're not. One day your currency buys groceries, the next day it's worthless paper. The transition happens faster than most people can react. That's why the gold signal matters so much. It gives you advanced warning. It tells you when the system is under stress before the stress becomes visible to everyone else. Gold doesn't care about political promises or central bank statements. It responds to mathematical reality. And mathematical reality says the current system is unsustainable. Think about the mechanics of what's happening right now. Governments worldwide have promised their citizens benefits they can't afford to pay. Pensions, healthcare, social programs, infrastructure spending. The commitments are enormous and they're growing every year. Meanwhile, the tax base is shrinking as populations age and productivity growth slows. The gap between promises and reality is widening. And there's only one way governments know how to fill it: create more money. But creating money doesn't create wealth. It just redistributes wealth from savers to debtors, from the prudent to the reckless, from those who hold currency to those who hold real assets. Every dollar printed dilutes the value of every dollar already in existence. It's a hidden tax that most people don't even realize they're paying until it's too late. The co-pandemic showed us exactly how this works. When the crisis hit, governments around the world printed trillions of dollars, euros, and yen to keep their economies afloat. They called it stimulus. They called it necessary. They called it temporary. But the money didn't disappear when the pandemic ended. It's still in the system, still driving up prices, still eroding purchasing power. Housing prices soared. Stock markets hit record highs. Commodity prices exploded, but wages for ordinary workers barely budged. The newly created money flowed to those who already owned assets while leaving everyone else further behind. This isn't an accident. This is how monetary inflation always works. It's a wealth transfer mechanism disguised as economic policy. Now, imagine this process accelerating. Imagine governments facing even bigger crises, even larger deficits, even more pressure to print money. The wars in Ukraine and the Middle East are draining treasuries. The banking sector is showing signs of stress. Commercial real estate is collapsing. Social unrest is growing. Each new crisis becomes an excuse for more money printing, more debt accumulation, more currency debasement. Meanwhile, gold sits outside the system entirely. It can't be printed, can't be digitally created, can't be manipulated by central bankers or politicians. Its supply grows by roughly 2% per year through mining, a rate that hasn't changed significantly in decades. While currencies can be created infinitely, gold remains finite. While governments can default on their promises, gold has no counterparty risk. While paper assets depend on trust in institutions, gold's value comes from its physical properties. That's why central banks are buying it so aggressively. They understand what's coming, even if they can't say it publicly. They're quietly preparing for a world where the current monetary system no longer functions. They're hedging their bets, diversifying their reserves, positioning themselves for whatever comes next. China's behavior is particularly telling. While publicly supporting the existing international monetary system, they've been accumulating gold at record rates. They've been reducing their dollar reserves while building gold stockpiles. They've been encouraging their citizens to buy gold and silver. They're preparing for a monetary reset that they know is inevitable. Russia has followed a similar path. After being cut off from the SWF banking system, they discovered the vulnerability of holding reserves in someone else's currency. They've been converting rubles into gold, building their reserves, reducing their dependence on Western financial systems. They learned the hard way that in a crisis, only assets you physically control are truly safe. Even traditional Western allies are quietly diversifying. Germany has been repatriating gold from foreign vaults. Switzerland has been accumulating gold reserves. Central banks across Europe, Asia, and Latin America have been net buyers for years. The trend is clear and accelerating. This institutional demand is happening while individual investors remain largely unaware. Most people still think of gold as an outdated relic, something their grandparents might have owned, but that has no place in a modern portfolio. They prefer stocks, bonds, real estate, cryptocurrency, anything that promises higher returns. They don't understand that in a monetary collapse, the highest return comes from not losing everything. The mathematics are becoming undeniable. With only 0.5% of global assets in gold, even a small shift in allocation creates enormous price pressure. If institutions and individuals moved just 2% of their wealth into gold, the available supply would be exhausted within months. Prices would have to rise dramatically to balance supply and demand. But the real catalyst won't be gradual portfolio reallocation. It will be crisis. When confidence in the monetary system finally breaks, when people realize their currency is becoming worthless, when banks start failing and governments start defaulting, the rush into gold will be panicked and desperate. By then, the price will be multiples of what it is today. The signal is already flashing. The pattern is already established. The only question is timing. Will the crisis hit in 2026, as many analysts predict? Will it come sooner? Will it be delayed by another round of money printing and intervention? Nobody knows exactly when, but the direction is clear. History doesn't repeat, but it rhymes with a rhythm so consistent it might as well be a metronome. Empire rises. Empire overextends. Empire debases its currency. Empire collapses. The gold signal warns of each transition. Those who heed it survive. Those who ignore it become footnotes in someone else's success story. Right now, you have a choice. You can trust that this time is different. That modern central bankers have solved the problems that destroyed Rome and Spain and Weimar, Germany. You can believe that infinite money printing will somehow create infinite prosperity. You can hope that the mathematical impossibility of exponential debt growth will somehow resolve itself peacefully. Or you can listen to what gold is telling you. You can recognize that the signal flashing today is the same signal that has warned of every monetary collapse in history. You can position yourself accordingly and prepare for what's coming. The choice you make in the next few months will determine whether you emerge from the coming crisis stronger or whether you join the millions throughout history who trusted their government's promises right up until the moment those promises turned to dust. Because here's what the history books don't tell you about monetary collapses. They don't happen to bad people or stupid people or people who deserved it. They happen to ordinary families who worked hard, saved money, and played by the rules. They happen to middle-class citizens who trusted banks, who believed in their currency, who thought their government would protect them. The barber in Weimar, Germany, who lost his life savings wasn't a fool. The Roman merchant who watched his denarii become worthless wasn't ignorant. The Spanish nobleman who saw his empire's gold slip away wasn't lazy. They were victims of a system that promised stability and delivered catastrophe. The cruelest part is how slowly it starts and how quickly it ends. For years, decades even, the warning signs build gradually. Prices rise a little faster than usual. Government debt grows a little larger than expected. Central banks print a little more money than they promised. People notice, but they adapt. They assume it's temporary. They trust that someone smarter than them has everything under control. Then comes the acceleration. What took years to develop takes months to unfold. What took months takes weeks. What took weeks happens overnight. The Lebanese who went to bed with money in the bank woke up with nothing to withdraw. The Zimbabweans who earned salaries on Friday found them worthless by Monday. The Germans who saved for retirement watched their pensions evaporate in real time. The transition from stability to chaos doesn't follow a gentle slope. It follows a cliff. And when that cliff arrives, it's too late to prepare. The gold that costs $4,000 today might cost $10,000 tomorrow and $50,000 next month. The banks that seem solid today might close their doors tomorrow. The currency that buys groceries today might be refused by merchants tomorrow. Preparation isn't something you do during the crisis. It's something you do before anyone realizes there's going to be a crisis. That's the real message of the gold signal. It's not telling you that disaster is guaranteed to strike on a specific date. It's telling you that the conditions for disaster are building and that smart money is already positioning for what comes next. Central banks aren't accumulating gold because they know something terrible will happen in 2026. They're accumulating gold because they know something terrible will happen eventually, and they want to be ready when it does. Think about what $4,000 gold actually means. It means the market has lost faith in every alternative store of value. It means investors worldwide are willing to pay historically unprecedented prices for an asset that generates no income, pays no dividends, and produces nothing except peace of mind. That's not speculation. That's desperation disguised as prudent planning. The professionals understand this, even if they can't say it publicly. Wealth managers at major banks are quietly suggesting their richest clients consider precious metals allocations. Pension funds are beginning to explore gold positions. Insurance companies are increasing their commodity exposure. These institutions manage trillions of dollars and employ teams of economists and analysts. When they start moving money toward gold, it's not because they're panicking. It's because they're calculating. Their calculations are based on the same mathematical impossibilities that have destroyed every previous monetary system. You cannot grow debt faster than economic output forever. You cannot print money faster than productive capacity grows forever. You cannot promise more benefits than you can afford to pay forever. The word forever keeps appearing in government promises, but it never appears in historical outcomes. Consider the timeline we're living through. The United States abandoned the gold standard in 1971, giving governments unlimited power to create money from nothing. Since then, debt has grown exponentially. Asset prices have inflated dramatically, and wealth inequality has reached levels not seen since the 1920s. Every crisis has been met with more money printing, more debt accumulation, more can kicking down the road. We're now 53 years into an experiment in unlimited fiat currency, and the stress fractures are showing everywhere. The housing market requires ever-increasing amounts of debt to maintain prices that young people can no longer afford. The stock market requires constant central bank intervention to prevent crashes. The government bond market requires the Federal Reserve to buy its own country's debt because foreign investors are losing interest. Each intervention requires more extreme measures than the last. Each solution creates bigger problems than the original crisis. This is exactly how Rome's currency crisis unfolded. Small debasements led to bigger debasements. Temporary measures became permanent policies. Emergency powers became standard operating procedures. The empire that once conquered the world ended up too weak to defend its own borders. Not because Romans suddenly became cowardly, but because their monetary system could no longer fund their military. Spain followed the same trajectory. The empire that received more treasure than any kingdom in history ended up bankrupt because they confused money with wealth. They thought endless streams of silver and gold meant endless prosperity. Instead, the treasure corrupted their economy, inflated their prices, and left them dependent on imports they couldn't ultimately afford. When the treasure ships stopped coming, the empire collapsed under the weight of its own success. The gold signal has been flashing for years, but most people still can't see it. They're too busy trusting institutions that have never kept their promises, believing in currencies that have never lasted forever, and hoping this time will be different when history screams that it never is. The choice is yours, but the window is closing. History doesn't repeat.